Now, the Monetary Policy Committee of the Central Bank of Nigeria has raised concerns over the nation's debt sustainability in light of the current global uncertainties. The committee, during its recent MPC meeting, stressed that the federal government's increasing debt profile is worrying, noting that there is a need for government to urgently diversify its revenue base. According to the Debt Management Office, Nigeria's total public debt rose to 41.6 trillion naira in the first quarter of 2022, while 86% of its revenue has been spent on debt servicing in 2021. Let's talk about this and understand what it means as we move on in the year and investment strategies with Afri Invest Assets Management Limited. Mr. Temitope Omoshuyi joins me now via Zoom. Thank you so much for your time, Mr. Omoshuyi. It's good to see you.
Thank you for having me.
Yes, the minister said yesterday, specifically during the MTEF briefing, that 1.94 trillion naira is what has been used to service debt in the first quarter, and that's about 310 billion naira more than the actual revenue received during this period. There is truly call for worry. What do you think?
All right, thank you so much for having me. I think the conversation around debt sustainability, it actually captures what we are talking about today. So when you talk about, debt sustainability assessment, you have to look at both solvency and liquidity. Before I go into a bit of background as to what debt sustainability is all about, I would like to say that, yes, there's a bit of worry that, debt service to revenue ratio is now over 100%, right? It's about 119% from January to April. So it has exceeded revenue because the number was 1.9 trillion compared to revenue of 1.6 trillion. So that's quite disturbing, right? At the glance, on the surface, it's quite disturbing. But when you drill down, it's quite clear that the problem is about revenue. However, if you look at debt service, I observed that, if you look at the component in terms of foreign and domestic debt, it's quite clear that the DMO is strategically managing domestic debts and foreign debt so as to ensure that, the susceptibility of Nigeria fiscal condition or, debt sustainability condition to exchange rate volatility is reduced. So what I mean by that is that, if you look at the prorated, the prorata, I beg your pardon, the prorata numbers for, debt service, particularly foreign debt, is shortfall of the budgeted number, which means the DMO has strategically been able to manage foreign debt service substantially to the extent that the authority did not even hit the planned, debt service, foreign debt service obligation. But for local debt service obligation, the authority actually exceeded. Yes, and this is understandable, right? Because we all know that government cannot really default on domestic obligation. Government can always refinance. And in fact, in finance, we always say that the safest, debt instruments are the ones issued in the local currency of that government, right? Because we know that government cannot default on the naira. So while looking at the, dollar obligation, it went down, like I said, it's about $332 million. The government actually expended on foreign debt obligation compared to the budgeted amount of about over $360 million. So if you calculate that, monthly is about 83 million. We spend about $83 million, to service foreign debt monthly. If you look at that in 1 year, it's about $1 billion, right? That's $1 billion in 1 year. And if you compare that to our foreign reserves, in fact, if you have our foreign reserve, which is currently at about 39 billion, if you divide it by 2, compared to what we need to service debt, there's no cause for alarm. However, we are already ticking up on the fiscal, the debt sustainability metrics. So what I mean by that is, there are certain threshold when it comes to debt sustainability. There's what we call, debt service to revenue ratio, and you have the debt stock to GDP ratio. For instance, if you look at government debt stock to revenue ratio, it's still less than 30%, and the IMF threshold is about 55%. But when you look at, debt service to revenue ratio, it has actually substantially exceeded, the threshold by a debt sustainability framework of about, 30 to 50%. So that could call for some kind of concern. But because a chunk of these debts, a chunk of this debt service obligation is in naira, is in domestic currency. So I think there's not much of worry, but we understand that we need to do better in terms of ensuring that liquidity and solvency risk to our debt sustainability condition should be properly addressed. We have to address it. However, there is no major problems to say if Nigeria will not be able to meet, external debt obligation as a result of increase in debt service, as a result of increase in debt service and as a result of increase in debt service to revenue ratio. Because of what I said, which is very important, government is strategically moving from external debt to domestic debt. And in fact, the major problem is from revenue. Because if you look at oil revenue, we've been talking about it since the beginning of this year, that oil revenue has been dwindling significantly. And despite this dwindling oil revenue, if you check foreign trade statistics, you observe that Q1 numbers, Nigeria trade statistics was surplus. So imagine if you had the opportunity to produce sufficiently, because for some months now we'll be doing less than 1.2 million barrel per day oil oil production. That is quite abysmal. Even amidst all that, you see that the foreign reserve is still a bit afloat. We are not seeing a significant decline. Even for foreign trade statistics as well, like I said, it's still surplus. So there are a bit of concern from the revenue side. In fact, the major driver of Nigeria revenue now seems to be the non-oil revenue, particularly the corporate tax. In fact, apart from the corporate tax that exceeded the budgeted amount, other income line, other revenue line actually underperform expectation, which is why policies need to be put in place to ensure that the real sector of the Nigerian economy, the private sector, must thrive, because the more vibrant Nigerian private sector are, the better for corporate, the company income tax, and it's also better for diversification. We know that in the long run, or in the short to medium term, it will reduce Nigeria's economic vulnerability to oil price volatility shocks, because now we've seen series of shocks. The world economy is now prone to shocks. We saw 2016, 2020, 2022, another one as a result of Russia invasion of Ukraine. So I think more effort has now been put to the private sector so as to ensure that we are diversified beyond just oil revenue, and we are getting a lot from non-oil revenue. Thank you.
Great stuff. I like that breakdown, and making us understand all of this, the domestic angle, the external angle, and what it means for Nigeria. But what is the economic implication if government continues with this current propensity for domestic debt? If it is sustained, what is the economic implication?
So for domestic debt, I think I'll have to emphasize that no economy can actually thrive in isolation of foreign inflows, particularly debt. It's just like running a company. So I think what is important is even to ensure that for every debt, there's corresponding asset. When you check a company's financial statements, once there's increase in liability, there should be increase in assets. I think what the government should begin to do right now is to begin to take stock of government assets. Because once there's increase in government debt, it should begin to reflect in infrastructure. I think the concern is because some of these debts are not leading to increase in assets that can generate enough revenue for the government. So I think if that is done, government should begin to take stock of infrastructure assets so as to tell even Nigerians that yes, debt is rising, but we have 1, 2, 3, 4, 5 assets that we can actually show for this, although they are not reflecting in our revenue. But in the next 1, 2 years, we'll see substantial increase in revenue. And government is not like companies that are there to optimize profit or revenue, right? Because you see a lot of intervention by the government that can never yield revenue. So I think attention should be drawn to that. In addition to what I've just said, again, we have to be careful. You have to be circumspect, because debt to GDP ratio is inching upward to the threshold of the IMF, right? That is why the analysis is quite inclusive. When I talk about solvency and liquidity analysis of debt sustainability assessment, if GDP is rising as a result of increasing, financing of important sector, growth elastic sector of the economy, from debt money, right? then it will help adjust the risk framework. It will help adjust these metrics. So what I'm saying in essence is that we just have to ensure that these inflows are properly spent and we monitor, debt sustainability metrics very, very well. I think the last time Nigeria actually did a comprehensive DSA, debt sustainability assessment, was in 2019. The DSA analysis will do a lot of risk ratio or scenario checks. They will do a kind of scenario checks on if there's going to be a major depreciation of the currency, if there's going to be a major drawdown foreign reserves, if there's going to be a major drawdown export, what if GDP declines significantly. So that was done in 2019, and it's a 30-year forecast from 2019 to 2030. Even though it seems we are still a bit okay, but we cannot be restless in terms of, our fiscal condition. Particularly, I think government has to pay attention to what we call the primary balance. We have to pay attention to what we call the primary balance, because primary balance exclude debt service. If a government is running positive primary balance, then the government is actually okay, because it's showing you that ordinarily your economy is in surplus, right? But what is creating the deficit is as a result of debt servicing. So, but the problem we have now is because we are not able to, address the primary balance properly, and it's now spilling over to overall balance, and it's taking a toll on debt service. So the current condition is still a bit okay, like I said, but we have to take caution because, debt service to revenue ratio is now very high, over 100%. Like I said, there's not much of concern because a chunk of this is, domestic debt, while debt stock, to GDP ratio is still significantly below IMF threshold. People argue that why should we focus on GDP, debt to GDP? GDP actually explains the potential of revenue generation. GDP explains the portion of what we get to government at some point, because government will tax all economic agent that makes up, GDP, from household, business, and external sector. So if a thriving GDP is achieved, you already know that it will dovetail into revenue, and that will bring down, debt service to revenue ratio. So I think, yes, we have to monitor all of these parameters from solvency indicators. Solvency indicators include, fiscal deficit to GDP ratio. We have debt stock to GDP ratio, debt stock to export, and why the liquidity ratio has to do with debt service to export and debt service to revenue ratio. All of these have, all of these indicators have threshold. We have to keep managing them. And we have to also let Nigeria know that these are the assets that correspond with every liability of the government. I think if we're able to do that and ensure that where we are putting this money is driving the economy, I think we are on the right course. Because if you look at other countries, actually, in terms of debt stock to GDP ratio is extremely high. Take the BRICS country. The only country that is an outlier is Russia. When you take the BRICS country, I mean Brazil, Russia, India, China, and South Africa. The only outlier is Russia, that the debt stock to GDP ratio is about 70%. Other countries are above 50%, right? Although most of these countries are able to manage revenue well. So I think it's actually very important for us to monitor these metrics. But for now, we don't have to throw caution into the wind. Thank you.
Let's do this in 1 minute. We'll wrap up now. We're already out of time. But do you think government is taking enough steps to generate IGR at the moment? Concrete steps to actually develop IGR. Let's wrap. 1 minute.
I think that we are not doing enough. Government is doing a lot, but they are not enough, because if you look at areas that can increase IGR, employment, once people are employed, you get personal income tax. Once businesses are thriving, you will get company income tax. Once export and import are strong, you get import duties and all of that. But because there are challenges, inherent challenges in the economy that is, inhibiting labor market health, that is affecting businesses, and is also affecting our international trade or external sector, I would say by the numbers we have, it's quite clear that government is not doing enough. I think we still have a lot to do in terms of ensuring that business environment is made accommodative, is made attractive, for businesses to thrive, so as to create more jobs for businesses to thrive, and to also drive, a strong international trade, which will enhance, import duties. All of this will definitely contribute to government revenue. Thank you.
I must thank you so much for your time there. I've been speaking to Mr. Temitope Omoshui. He's an investment strategist with Afri Invest Assets Management Limited. I do enjoy your weekend. Thank you so much.
All right, thank you. Yeah.